Silver was in melt up. When I have something that's in melt up, I usually sell it. I save in gold, I speculate in silver. Precious metals will do extremely well for the next 10 years. I say unfortunately because a set of circumstances that is good for precious metals is bad for most of the rest of your financial life. I'm less troubled owning gold and silver. What I consider to be secular bull markets, like today, there can be periodic declines. Our obligations to bondholders are almost $40 trillion, 115% of GDP. Our off-balance sheet liabilities are worse. Medicare, Medicaid, Social Security, military pensions, federal pensions, it's basically a call on future income, is $120 trillion. We could tell the pensioners, yeah, you paid in for 60 years, but no, you aren't getting out. We're going to have a dishonest default.
And that's why you're so bullish on gold. The president wanted the Fed to cut rates. It was reflected in interest rate expectations. US dollar was going lower on the back of that. Gold was going higher. But that all changed with the war. Then now interest rates are going to be going up. Higher US dollars putting pressure on gold. What are your views in the back half of the year on the price of gold and silver? Let's move on now and discuss something that I know you love, and that's gold and silver. And gold is flat on the year. Silver is down 8% on the year, if you can believe that. And gold peaked at 5,500. Now it's around 4,400. Silver 110. Now it's at 62, down 43% from the highs. Rick, does that surprise you?
No, not particularly. I'm not a market player in that regard. I began saving principally in gold in the year 2000. And I think gold was 250, 260, something like that. So when people tell me it's down, I think, really? Not down for me. No, did I buy some at more than today's price? Sure. That doesn't matter. It's savings for me. Uh, you know, so it doesn't matter. Silver was different. Silver, I made a fairly well publicized sell decision in January of this year as a consequence of a hockey stick chart. Uh, Silver was in melt up. And when I have something that's in melt up, I usually sell it. Silver, too, occupied a speculative part of my portfolio, not an investment part of my portfolio. I save in gold, I speculate in silver. And my speculation in silver had to do with the fact that it was hated. In January, it was anything but hated. So the reason to own it for me disappeared. And because the reason to own it disappeared, I sold it. Um, I believe, unfortunately, and I really do think it's unfortunate, that precious metals will do extremely well for the next 10 years. I say unfortunately because a set of circumstances that is good for precious metals is bad for most of the rest of your financial life. Precious metals for 1,000 years have done well, particularly during times when people were concerned about the maintenance of their purchasing power in fiat instruments, things like government bonds. Uh, Times when people are concerned are usually troubled times. And I would prefer personally not to live in troubled times. Since I'm coming into 10 years that I think will be fairly troubled, I'm less troubled owning gold and silver. I know from prior bull and bear markets that even in what I consider to be secular bull markets like today, there can be periodic declines. I'll take your audience as an example back through history to the decade of the 70s, the greatest bull market, certainly of my lifetime. The broad view was that gold increased from $35 an ounce, admittedly price controlled, to $850 an ounce. An epic performance, what, 25, 26-fold increase? In the middle of that in 1975, when there was political pressure in the United States to deal with inflation, and the political class allowed or caused the interest rate to go up, the gold price fell by 50%. In a secular gold bull market, the gold price fell by 50% in 9 short months. Two lessons there. Many of the people that in the period 1970 to 1975 developed an almost religious belief in gold hated the fact that they learned how to spell it and got shaken out after a 50% decline. Those people who got shaken out didn't understand history either, because that increase in the interest rate destroyed the new home market, destroyed the automobile industry, destroyed the equity market, destroyed the bond market. The political class lost their nerve, forced interest rates down, announced to the world that US politics was more important than the sanctity of the US dollar. And the gold price ran from $100 an ounce at the end of 1975 to $850 an ounce 6 years later. That lesson is important for people. Past is prologue. If you believe yourself that the next 10 years will see lower or dramatically lower purchasing power in currencies like the US dollar or the Canadian dollar, or in instruments like US treasuries or Canadian sovereign debt, then you need to own gold. And you need to own it not as a speculative asset or even as an investment asset, but rather as savings, as a store of wealth. If you have a different belief, all I can say is best of luck to you. I don't understand how to shield my family's purchasing power by owning a stock at 100 times revenue. I'm not saying you can't do it. I'm just saying that I can't do it. What I can do is look at 1,000 years of recorded history, 73 of which I've been on Earth, 50 of which I've been sentient, and understand in that context that passes prologue, and I own gold.
And just provide a little more context to what you were saying about the money supply and money printing. In January of 2020, before all the craziness started, the money supply as measured by M2 was 15.4 trillion. Now it's well over 22 trillion. That's an increase of over 40%. God knows what it is today. It's probably even 22 trillion now. Who knows? But this is the problem. It's not the value of your house has gone up by 30, 40, 50%. It's because of the purchasing power of your dollars has been effectively cut in half.
One of the things I do, because I began saving in gold in 2020, is I mentally construct the price of things in Y2K, year 2000 gold. And if you measure the price of things in gold, you are struck by how cheap things are. Houses are cheap. Gasoline is cheap. Food is cheap. Medical care is cheap. If you measure those same things in dollars, you're struck by how expensive things are. And there's a lesson there. You mentioned money supply. I think the other thing that your listeners need to do is look at the probability of more quantum changes in money supply. I can't give you the Canadian numbers, but in the US, and these numbers are stupefying, our on balance sheet obligations, which is to say our obligations to bondholders, are almost $40 trillion, 115% of GDP. Our off balance sheet liabilities are worse: Medicare, Medicaid, Social Security, military pensions, federal pensions. The net present value of off balance sheet obligations, basically a call on future income, is $120 trillion. Now, the chance that the United States can simultaneously satisfy the bondholders and simultaneously satisfy the social demands of its citizenry with the economy the size of it is right now is nil. The arithmetic chance is nil. There is no way. The Internal Revenue Service estimates that the private net worth of Americans, assuming that we don't foreclose on Yosemite and hawk our nuclear aircraft carriers, is $172 trillion. So we're worth 172 and we owe 160. There's a $12 trillion delta. And that delta gets eaten up every year: $2 trillion in off balance sheet liabilities and $2 trillion in on balance sheet liabilities, which is to say 3 years from now, we're going to be flat. Now, how do we get out of this? Well, there's two ways. We could be honest, like the Argentines, and default. We could tell the bondholders, too bad, so sad. We owe you no money. We could tell the pensioners, which we probably should do, at least the rich ones like me, yeah, you paid in for 60 years, but no, you aren't getting out. But that's not the American way, nor the Canadian way. What we're going to do is we're going to have a dishonest default. If you think the money supply growth that you've seen in the past is excessive, wait till you see the way we deal with $160 trillion in liabilities in the next 10 years.
And that's why you're so bullish on gold. All right, so
Correct.
let's look so when we look at this year, I can't believe it's already halfway through the year, but back in January, the consensus was we were going to be cutting rates. Okay. The president wanted the Fed to cut rates. And that was reflected in uh, interest rate expectations. The US dollar was going lower on the back of that. Gold was going higher. But that all changed with the war. And then next thing you know, oil's trading at $100 a barrel or higher. And we have inflation percolating through the economy. And now the consensus is interest rates are going to be going up in the back half of the year. And that's resulting in a higher US dollars, putting pressure on gold. What are your views like in the back half of the year on the price of gold and silver? Do you think they're going to
Uh,
continue to be under pressure because of these factors?
until the political class really tries to cut the interest rates. I mean, first of all, the market's taken control of the long bond. That's out of control of the Fed. The Fed is still doing whatever it can to manipulate the short rate lower, but the market's taken over the long rate, much to the chagrin of the Fed. To the extent that the long bond continues to be relatively strong, the US dollar likely continues to be relatively strong, and gold continues to be relatively weak. I draw you back to our earlier discussion of 1975. Higher US interest rates led to a lower gold price. Higher US interest rates will murder the bond business, and they won't ultimately be good for the equities business because the cost of capital goes up and the capitalized distribution value of dividends will go down relative to the bonds. It's my belief that there will be political demands in the United States to do exactly the wrong thing, which is to cut interest rates. The United States political class and the commercial class, by the way, decided in 1975 that US politics was more important than the sanctity of the dollar. And they'll do it again. The other thing to consider, and I'm not saying that this is going to happen with any immediacy, is that whenever we have a fiscal crisis in the United States, or for that matter, when anybody has a fiscal crisis anywhere in the world, the US policy response is to artificially lower interest rates and flood the market with liquidity. You will recall 2008 when the US Treasury said, quote, we will do whatever it takes. What it took was counterfeiting, massive doses of counterfeiting. The difference between then and now is that US on balance sheet liabilities were less than 40% of GDP. In other words, there was a lot of string on that. There was a lot of room in that string to push. On balance sheet liabilities now are 115% of GDP. The ability of the capital markets to have the confidence of the type of quantitative easing, which, let's face it, is counterfeiting, that accompanied the 2008 crash is much, much less. The moral suasion that the US has with its current balance sheet and its income statement is much lower than it was in 2008. But the probability of a 2008 style event, I'm not saying it's going to occur, but the probability of a 2008 style event with problems in private credit, with the dislocation of the world economy as a consequence of the war, those probabilities are probably increased. Not saying it's going to happen, but if it did, the ability of the US government to solve that problem with the way it used to, which is to say, create liquidity, without positively impacting the gold price, the same way that the gold price got impacted in 2075, is, I would suggest to you, nil.
And what's your message to investors who might have got long gold or silver equities like in Q4, Q1 at significantly higher prices, and now they're scratching their heads and wondering, well, why the hell didn't they just buy Micron or Intel?
Well, if they think they know enough about Micron or Intel to buy them, by all means they should. I don't think they do. Uh, money is made, in my opinion, on the delta between price and value. And most investors don't take enough time to understand value. They only pay attention to price. If you pay attention to the delta between price and value, and prices fall, you buy more. Many of your listeners are familiar with my old mentor and partner, Eric Sprott, and they think that Eric Sprott is a one-way machine. They think he only buys. Uh, his art collection in his condo in Toronto will tell you that he sells. Eric, despite his bullish prognostications, started his career as a CA. He has two pricing scenarios, one at today's gold and silver prices, and a different one at a gold and silver price that he thinks is probable in the 3 to 5 year time frame. And he also consistently does comparative valuations between his holdings. In other words, he looks at a holding that doesn't exhibit what he would consider to be optimal leverage. He sells it and he rebalances into companies that have a better relation to the leverage he's looking for. Most speculators, by contrast, uh, follow a tenet called "got a hunch, bet a bunch." Uh, those people didn't understand what their stocks were worth in the fourth quarter of 2025, and they don't understand what their stocks are worth today. And as a consequence, lower share prices cause them trauma. For me, lower share prices are like goods on sale. I mean, can you imagine walking into one of those malls in downtown Toronto, those wonderful underground malls with all these stores, and they put up a for sale sign and everybody leaves the store? Uh, this is truly silly.
Rick, we touched on, man, I think we covered all our bases here. We touched on oil, nat gas, uranium, gold, silver. I got one more to ask you about, and that's copper.